Hey everyone, welcome back to the Finmineering channel, where we look into and summarize publicly traded mining stock reports so that you don't have to. Today we're breaking down Whitehaven Coal, ticker WHC on the ASX, an Aussie coal giant that's been smashing records while navigating some choppy waters. We'll cover their recent performance, financials, and what we think about the company for 2026. So let's jump in. Actually, before we dive into Whitehaven, let's address the elephant in the room. Coal. There, I said it. The C word. It can be a controversial topic in today's climate discussions. But here's why it's worth talking about. You see, coal has powered the rise of first world nations by providing cheap, reliable energy that fueled industrialization and lifted billions out of poverty. Think about it. Without coal producing the reliable baseload power and steel, factories, home, and infrastructure in places like Australia, the US, and Europe might not have been possible at the scale we see today. Now that same affordable energy is crucial for developing nations in places like Asia and Africa, where billions of people still need access to reliable and cheap electricity to grow economies and improve lives. And get this. Even in 2026, coal's role in security is making headlines. Just this week, US President Donald Trump signed an executive order directing the Department of War to buy more electricity from coal-fired plants to ensure uninterrupted power at military bases. This includes long-term contracts and about $175 million in funding to upgrade coal plants in states like Kentucky and West Virginia. It's a reminder that for national defense and energy reliability, coal isn't going anywhere anytime soon. Noting, of course, that there must be a healthy balance. Speaking of balance, coal comes in two main types, thermal and metallurgical coal. Thermal coal is a lower quality coal with higher moisture and ash content. Metallurgical coal is a higher quality coal with relatively low ash and sulfur content. Thermal coal is primarily burned for electricity generation, providing that steady base load that we just spoke about. By the way, the big white plumes of what people sometimes incorrectly refer to as smoke, seen at coal fire station cooling towers, is not pollution. It is water vapor that is produced by cooling hot water so that it can be reused for power generation. Metallurgical coal, or met coal, it's different. It's used in steel making, where it's essential for producing coke that reduces iron ore into steel. Why is that important? Well, steel is the backbone of modern infrastructure, from buildings and bridges to cars and ships. And here's the irony, even renewables rely on it. Wind turbines, for example, need thousands of tons of steel per unit. And that steel requires high quality met coal to produce it. So the demand for met coal isn't vanishing anytime soon either. Another aspect of coal mining that is worth noting is that typical coal mines, especially open cut coal mines, are progressively rehabilitating over the life of those mines. As one strip is mined, the overburden from the next strip is used to backfill the previous one, allowing almost immediate topsoiling and revegetation. This minimizes the overall disturbed footprint, reduces erosion and dust, and spreads the rehabilitation costs over the life of the mine. The benefits includes lower final closure costs and better environmental outcomes. Now, let's dive into Whitehaven. First up, operations. Whitehaven absolutely crushed it in FY25 with record managed ROM production of almost 40 million tonnes. That's up a whopping 60% from FY24's 24.5 million tonnes. You can see here that coal production has been stable with good performances in the June and December quarters especially. Equity sales hit 26.5 million tonnes, up 61%. The surge? Well, it's thanks to the full year integration of the Daunia and Blackwater operations in Queensland, flipping their revenue mix to 64% met coal from just 31% the year before. Whitehaven does not own all the assets in its portfolio 100%. However, it is the majority stakeholder across all the assets, with the lowest ownership level, about 70%, at the Blackwater mine. We can see from the graph below Whitehaven's share of coal split across assets in Queensland and New South Wales. The colour choices are quite deliberate for those rugby league fans. Safety is improving as well. The TRIFR, or Total Recordable Injury Frequency Rate, was at 4.6 at the end of FY25 and is down to 2.9 at the end of H1 and FY26. FY25 unit costs was $139 per tonne, which was better than guidance, and $100 million in annualised savings locked in. CapEx came in at $390 million, which was under budget. Fast forward to H1 FY26, and already 20 million tonnes has been delivered to the ROM, and 12.8 million tonnes have been sold. Costs were at about $135 per tonne, which is at the low end of their guidance, being $130 to $145 per tonne. They're on track for their FY26 targets of 37 to 41 million tonnes delivered to the ROM and 25 to 28 million tonnes in sales. Further savings identified total up to about $80 million, which hopefully the company can realise by the end of the year. Compared to FY24, FY25 shows real resilience despite softer coal prices in the second half. Now, let's zoom into the assets. The Queensland assets are performing well and are predominantly met coal focused amid rising steel demand. Daunia is 100% owned and delivered 5.8 million tonnes to the ROM in FY25, up from FY24. Yields were 78 to 80% and sales 4.7 million tonnes. In H1 FY26, 3.1 million tonnes has been delivered to the ROM so far, and it's looking like a consistent performer with minimal hiccups. Blackwater, which the company now only has a 70% equity stake in after the April 2025 joint venture, FY25 ROM deliveries totaled 14.2 million tonnes, yields up to 83%, and sales 11.1 million tonnes. H1 FY26, 7.3 million tonnes to the ROM so far. Integration has been smoothed, and that 30% sell down netted almost $400 million. Over to New South Wales, which primarily focuses on thermal and semi-soft coal. The Maules Creek operation is owned 75%. FY25 ROM deliveries totaled 11.5 million tonnes. Sales were 7.8 million tonnes, and yields were around 75%. The asset held strong despite floods, and by H1 FY26 has delivered 4.8 million tonnes to the ROM. Narrabri, which is a 77.5% equity stake, delivered 4.3 million tonnes in FY25 to the ROM and was impacted by longwall moves, which only produced about 0.4 million tonnes in the fourth quarter. The asset looks to have rebounded in the first half of FY26 with 3.1 million tonnes to the ROM and strong sales in the second quarter. The Stage 3 extension pushes the mine life to 2044. Gunnedah Open Cuts is owned 100%. FY25 delivered 3.3 million tonnes to the ROM, and H1 FY26 so far has produced 1.8 million tonnes. It's an efficient operation, and the Tarrawonga extension has been announced to 2045. The Queensland assets really stepped up, producing almost 51% of ROM totals over FY25, while the New South Wales assets showed grit against weather and sequencing challenges. We'll put some of the charts that we've shown here at the back of the video for ease of reference. Financially, FY25 was a bit mixed. Growth was offset by coal price drops during the year. However, revenue soared by 53% to $5.8 billion, with Queensland assets contributing about $3.5 billion of that. Underlying EBITDA was $1.4 billion, flat year on year, but statutory net profit after tax was almost $650 million, up 83% thanks to the one-offs like Blackwater joint venture and a $413 million contingent payment after adjustment. Compared to financial year 24, where revenue was only $3.8 billion and EBITDA was $1.4 billion. Underlying net profit after tax was only $320 million, which was down 57%. This was driven mainly by lower coal prices over the course of the financial year. Cash from operations totaled about $1.3 billion and net debt was slashed to $0.6 billion. The company paid 15 cents per share, totaling about $191 million, plus it bought back $23 million worth of shares. In H1 FY26, with low net debt, no contingent payments expected anytime soon, the company is in a strong position for volatility. What about risks? Well, coal prices have been really volatile. That being said, met coal prices is up about 9% quarter on quarter in FY26, but thermal coal is a bit more steady, slightly trending up. Weather, like the floods in New South Wales, and operational hiccups like at Narrabri, continue to remain watch points. The sales mix between thermal and met coal was more balanced during the second half of the calendar year than in previous periods shown, and coal prices have been trending up, as mentioned before. The outlook is pretty strong. There's good demand from especially Asia. However, cost discipline will be key for the company. No one knows how a rock will break, but FY26 guidance looks achievable, with potential for more dividends. At $8.60 a share at the time of recording, and a market cap of approximately $7.1 billion, I wonder whether this company may be undervalued. So, Whitehaven is performing well, and the last 12 to 18 months has been strong, especially considering the headwinds that coal has faced in general. The company's balance sheet is solid, and I don't see any major red flags. If you're investing in ASX miners, this company might be worth watching out for. But I'm interested to know what you think. Buy, hold, or sell? Drop us a comment below. If you found this video interesting, please like and subscribe for more breakdowns like this. Thanks for watching, and until next time, see ya.